Hello, everybody. Welcome to the Closing Beat remote edition, right? Special remote edition here from the Jazz After Dark studios because it's a shortened week. And did you see the market today? Not a whole lot of excitement going on there. So I won't take a lot of your time, but we do have a handful of things that I'd like to share with you. And of course, I want to make this worth your while. We are financial advisors here at Jazz Wealth and hope you'll check us out at jazzwealth.com. Let's start with the market here. So here's the S&P here today, right? Or no, this is over the year, but over here is today. You see anything interesting? I'll zoom in for you. You see anything interesting going on here today? Nothing, right? I want you guys to keep this in mind next year when July 4th falls on Wednesday, right? So it's going to be just as boring before and just as boring after. It's totally normal. Volume lower, basically next to nothing. Remember, this was a half day here, so it doesn't really count, but volume, of course, a lot lighter there. Our biggest news here today, our biggest exciting news today was the financial conditions impulse on growth. That's what the Fed came out with. It's basically an index that other analysts have kind of used. They just changed the movement around it a little bit. But basically, it takes a look at the financial impact of changes that they make, right? So how it affects GDP and how it affects growth, how it affects the housing market. They actually are using Zillow's data in there. Thought that was pretty cool. So that was like one of the only exciting things there. Now, if we look back over here, so we obviously have a little bit of a rally going on, right? And this is a quiet week, so we don't expect like just to be a takeoff, massive rally or something. But our rolling 1 year return here is at 19.6%. Is that a lot? 19.6%. 11.8 is our average rolling 1 year return in the S&P. That's going back the entire lifespan. That's all the way to September 1928. You look at it, your rolling 1 year return at any point, you go, what's the average return? If I just pick a 1 year period, 11.8. This is not year by year. This is just, hey, pick a spot from here, go 1 year forward. What do you get? 11.8%. We're sitting at basically double that. Okay, so that's something to consider there. And if we're going to go over to the first slide here and actually show you what years look like this so far. So here we have 1989. It is officially the most correlated year to 2023 so far, right? So if you look at the red line there, that's this year. Blue line is what happened in 1989. Okay, so if history repeats itself in any way that's even close to history, looks kind of impressive, doesn't it? A nice rally. The problem is the second most correlated year is 1950. And well, look at that. So we were right on the cusp of like in 1950, we basically did the exact same thing January through the end of June. And then big collapse there to give back the entire year's worth of gains, only temporarily, but still it was a massive pullback. So those 2 years, 1989, 1950, the most correlated, but wildly different outcomes in the second half of the year. Kind of fascinating there. Now, the lesson here is we don't know what's going to happen from here, right? So you have to probably want to play defense, of course, with some of your stuff that's really just taken off, anything that has AI in it, of course, there. But remember what got us here, right? So what got us to that 1 year return of 19.8%? Basically 20 if you count today. Remember who's responsible for the year-to-date gains. Okay, so the next slide that I've got up for you here is a breakdown of who is responsible. What sector is responsible for these years-to-date gains? I shared this in our Notes from Jazz email as well, which was a video for clients. But all we're really trying to show is technology is responsible for 62% of the year-to-date gains. If you're not in technology, you do not have the same returns as the market. If you're all in technology, you have returns that are way greater than the stock market there, okay? I show it this way because it's easy to see healthcare contributed nothing, right? I do all the math in the background for you. Oh, healthcare is not giving anything. It has no contribution to the year-to-date gains. It's easy to see technology, consumer discretionary, they're doing all the heavy lifting. Goldman Sachs on the next slide chooses to be a little bit more geeky. I took a look just to see what do they have. This is how they determine who's participating in the market. Yeah, there's the formula at the bottom. I was able to get that there. Basically, it's showing the same thing, that all of the participation is only in one technology side of the market right now. Everything else is just not participating. They're using they're calling it their Goldman Sachs breadth index, and it's basically showing participation is very low. We then just went a step further to go, hey, how do you get that math? How do you do those numbers? Yeah, it's more geeky than I am there. So kind of interesting there. What else do we want to talk about there? Oh, speaking of bonds here, how can we do this? We'll go down a couple slides. We shared this before, but the correlation between the S&P and bonds is widening. So that'd be slide number 8 if we can get there. But that correlation, we pointed out the other day that the stock market has a hard time going up when yields are going up or interest rates are going up. Did you see what happened today? That unfortunately became another issue here today. If we go over to bonds, you could use really anything. I'll use future. I just usually use the futures. Another decline here in the price of bonds, which means yields went up. So really kind of unfortunate, because if we go back to that slide, that means we have a wider divergence in that bonds versus the market there. Again, this is just a geeky way of showing you, if interest rates stay high, how can you have a market that continues to move higher? It can digest it, right? We've seen that before, but real trouble when it comes to what's happening over here in that space. Just one of those things like, hey, just going to point it out ahead of time. We'll see what happens there. All right. I'll keep this one short today since we're just sort of experimenting. I'm going to pop on over here, turn on these charts. Got a couple stocks in the news, and then we'll move on. Meta. So Meta in the news here today that they're going to launch, what do they call it? Threads? Yeah, they called it Threads. It's basically a Twitter copy. I really despise Meta for doing this stuff. I don't know how it affects their bottom line, but they're just a company that copies other people. They copied the Instagram stories, you name it, basically. When Periscope came out and did its thing, they copied that. They're basically saying, we're just going to replicate Twitter and hope that people use it on Facebook, or Meta in this case. So that was what was in the news there, because of the throttling that Elon Musk had done for the AI bots and chat bots and the scrapers out there. That's just people trying to pounce on some temporarily bad news. I don't know. I don't like it. Rivian, more and more of their little trucks are running around here that I see. I don't know what's happening there. First deliveries, they did 300 of their Rivian vans in Europe. And it doesn't matter really what the news was today, because you notice for Rivian, if you happen to have it or watch it, that the positive news cycle is just picking up. The rate of change of how many positive news articles and releases there are for Rivian is increasing exponentially. So they're just using this momentum there. And of course, when people talk about it, more people will talk about it. And that's gets people to focus back on the stock. UPS having some issues there. I did not get a chance to look at this one here. The Teamsters Union says the company officially has walked away from the bargaining table for contract discussions there. And I didn't get to do much more there. Saw it impacted the stock here just a little bit today, but that's basically it there. And Monster, one that I can talk a lot about because we happen to own this stock. Monster is going to buy Bang Energy for basically $362 million, plus they're taking over some of their debt there. Why would they do this? Anybody curious here? Anybody curious? Because I could talk about this one for a while. I've done, obviously, owning that stock in our portfolios here at Jazz. We've done a lot of discussion there. But Bang Energy recently bought a production facility that is probably the most state of the art production facility. They can pump out 3,600 cans a minute. It's incredible what they can do. They can use alcohol or put alcohol in drinks there. They can change sizes on a dime and just make different size cans and stuff. Very, very cool. Why would Monster buy Bang Energy? Has nothing to do with that factory. It's a nice bonus, but what they're trying to do is they're trying to say we have Monster. Well, at the moment, they have Monster and they have Rain, which is their other drink, and now we'll have Bang. That means we will have three different price points. So we can sort of get out there to the market with three different price points. Not only that, they have Coca-Cola's distribution. So it's like, hey, we can conquer each price level now in the market and basically beat out everybody else. We have the premium product, we have middle of the road, and we'll have the discounted, or they have the discounted product. And so that's one of the main reasons there. I think probably secondarily is the fact that Monster has wanted to experiment with alcoholic drinks in the past. So maybe they decide to do that. But that's more of my 2 cents as to what's happening there, just because that one I know about. UPS, I do not. All right. We good? Right. We may test this out again tomorrow, right? See what happens there, but expect another quiet day as far as the market goes. We'll be here, of course. If you have any questions, you're welcome to check us out at jazzwealth.com. You know where to find us. And see you for the Jazz After Dark, huh? Yeah. Adios.